Coming up at the top of the hour on Power Lunch, breaking news on the Fed, and it could be a market mover. We'll have the headlines as they cross, plus the Fed's latest decision may have just made this sector a big bargain. We'll tell you which sector we're talking about. Also, October, usually a bit of a scary time for investors, but this may actually be the month to buy stocks. Why you shouldn't fear Octoberphobia. Also, Goldman Sachs may be a big play for mom and pop investors, unveiling a line of low-cost ETFs. Can Goldman take on the giants, Vanguard, BlackRock, and State Street? Well, Goldman's global head of ETF strategy will be joining us exclusively, so we can ask that question. All those things and, of course, lots more at the top of the hour on Power Lunch. Scotty, back over to you.
All right, Mandy, thanks. We'll be there. Our call of the day, Oppenheimer getting bullish on Goldman after being on the sidelines for years. The firm has upgraded the stock today to outperform, thinking it can rally nearly 30% over the next year. Chris Katowski, the analyst behind the call, joins us live today from New York City. Chris, welcome back.
Welcome. Thank you for having me.
Why off the sidelines now?
Well, first of all, why were we on the sidelines?
Okay.
And the answer was we've been negative on the trading environment and trading revenues for the big banks. And for the industry, like in 2010, the industry earned around $145 billion of revenues. 2014, that was down to 110. So it's been under secular pressure, and fixed income trading actually is down on a year-over-year basis, 17 out of the last 22 quarters. So that's why we've been away from the investment banks and focused more on the commercial banks. And, you know, what you've had this year is that the commercial banks have all run in anticipation of benefits from lower rates next year. And these stocks have lagged behind. And, you know, the interesting thing about Goldman is that despite that adverse trend in trading revenues industry-wide, it's actually earned a slightly higher return on equity than the banking industry overall. So Goldman, over the last 4 years, has averaged on a core operating basis just shy of a 12% return on tangible equity. And that's versus the industry or commercial banking industry average of around 11.3. So it's slightly better, but it's at a multiple discount of more than 20%.
It's interesting. I mean, the words you use in your note, the reasons why Goldman and other these big financial institutions could not do well in this environment have certainly been laid out. You're very honest in saying, hey, we've made these same arguments.
We have, and they've kept on earning.
But now maybe they don't hold as much water as we thought.
Well, I think the thing is, you know, the stock is now near tangible book. It's 1.1 times tangible book, so I don't see a lot of downside risk. And I think the stock does okay even in just a muddle-through environment. But then there are different ways to win. Way number one that you can win is the fact that the less capital-intensive businesses like investment banking, asset management, and so on now account for about 60% of Goldman's revenue mix. So that's gone up. And then the other way that you'd really win big is if the Fed does lift rates, and this makes fixed income markets more active, and that could generate a return in fixed income trading revenues for the industry. You know, we're not counting on that, but those are ways to win.
Mm-hmm. So, Chris, it's Joe. Let's pick up on that point, because Morgan Stanley has done an incredible job over the last couple of years on the wealth management side, on asset management. They've been able to grow their profit margins. Goldman Sachs has talked about doing something similar on the wealth management side. Do you suspect Goldman goes out, makes an acquisition, strengthens or possibly buys an asset manager to strengthen the wealth management division?
Goldman has done remarkably few acquisitions over time, right? Aaron and Spear Leeds Kellogg. I mean, those are the two major ones. So it's less likely. It's not impossible, but it's less likely. And also, the other thing to keep in mind for both Morgan Stanley and Goldman Sachs is Goldman has roughly $72 billion of tangible common equity. Morgan Stanley has roughly $60 billion of tangible common equity. You know, both of these companies have a tremendous amount of capital that they need to put to work, and that the Fed, as of now, is not letting them return to their shareholders. So both Goldman and Morgan, they also need the fixed income trading business. That's where they put their capital to work.
Hey, Chris, great call. Full disclosure, I've known you 25 years
yeah.
and love your work. But You really didn't spend too much time on the M&A environment. To me, that seems like it's heating up, and more so cross-border. And Goldman and also Morgan Stanley are very, very well positioned there. Do you think that's recognized in the stock price right now?
Well, M&A is still probably, if you look at M&A relative to the size of the economy and relative to the size of the stock market, M&A is still probably only about 70% of where it normally is. So M&A still has room to go up, and certainly that leads to good opportunities, not just on M&A, but financing those transactions. And it also is one of the reasons why I'm so bullish on the private equity companies as well. I think M&A has a long way to go, and you're right. I think Goldman wins on that. I think Morgan Stanley wins on that. I think the private equity guys win on that.
Chris, it's great to talk to you. Thanks for coming on and talking about this call.
Thank you.
All right, Chris Katowski over at Oppenheimer. Thought?
No, I was going to ask him sort of a separate banking question that we're not paying any attention to, but ultimately when the Fed starts to raise rates, there's a lot of question about deposits at a lot of these banks and what effect that's going to have on net interest margins and loan activity and so on and so forth.
Well, that's why people are trying to get more bullish on the banks for that very reason.
I would also add, I wanted to ask him, and maybe we have a view here, his arguments in favor of trading revenue and the broader environments have absolutely come to pass, and yet the stock has gone from 80, 90 bucks up to 200, now back to 180. You know, what was it about Goldman along the way where the stock effectively doubled, even though the broader environment was, as he noted correctly, not good?
Anything else you wanted to ask him, or was that just a
No, I had a lot of...
It's filled with questions.
I have a lot of questions for people.
Judge, I think the most important thing is how many times have we heard in the last couple of weeks somebody else is going after Goldman in a positive way? And they're talking about the valuations, and everybody's talking about M&A. There's a lot of good reasons. When you see the stock trading at about $183 a share, it was well over 200. It's understandable why so many folks have gotten more and more bullish about this call.
Goldman just has a way, I'm going to answer one of his questions, to build new businesses, to increase businesses, what they've done in the hedge fund space, the prime brokerage business, and the competition's narrowed. It's clearly the class act of the group.
I know you have something to say.
Let's take it. Let's do the tease and take it to commercial break.
Okay, coming up, Joe is going under the radar on one travel stock. Stick around to find out the headline. Dan Greenhouse is going to ask him what it is. Plus, could the Emmy winners last night that could also be winners for your portfolio? You're watching CNBC, First in Business Worldwide.